Thank you for joining us for our webinar today, Exit Planning, Preparing Your Business for a Third-Party Sale. Before we get started, I wanted to mention that there's a chat feature for this webinar, and you can ask your questions at any time during the presentation. The chat button is at the bottom of the PowerPoint as you hover over it. We will answer all the questions at the end of the webinar during the Q&A portion, but feel free to ask questions via chat as you think of them. Our presenter today is Nicole Grollup. Nicole is a principal with SBA Certified Public Accountants. She provides clients with technical expertise in areas such as tax planning, financial reporting, financial projections, budgeting, financial and estate planning, and review of internal controls. Nicole also leads SBA's exit planning business strategy using the BEI 7-step exit planning process, which she will discuss today. And with that, I will pass it over to Nicole.
Good morning, everybody. Thank you for joining us. So let's just get started by going over some statistics on where are people at with this topic. So BEI did a survey, and what they found was 79% of business owners plan to exit their business in the next 10 years. So that's a really high number, and that means that there's going to be a lot of inventory on the market. And some inventory may get sold, may not get sold. So you really want to plan so you're part of the 79% that are successful to exit in the next 10 years. So with that, the next thing is what percentage of business owners have talked to their family? And that's 78%. So of the 79% that plan to sell, 78% have talked to their family. So that's pretty high. And hopefully all the family is in alignment on what's going to happen. But only 17% of business owners actually have their plans in writing. So that's a really low number. That really means that 83% are kind of flying by the seat of their pants. So when you got into business, you made a business plan on what was going to happen, how you were going to get into business, what was going to happen while you were into business. So why not an exit plan? So it's guaranteed that you're going to get out of your business at some point, so you really need a plan on how you're going to successfully exit. So exit planning is planning for the single most critically important financial event of your life, which is really transitioning out of your business. So let's talk about what exit planning is. Exit planning is done through a systematic approach which starts by looking at all your possible goals and objectives and all the possible actions you can take to achieve those goals. All those possibilities are then narrowed down into the best solution for giving your objectives. So oftentimes business owners will ask, well, how should I exit my business? Well, no two businesses are alike and no two individuals are alike. So it's really a tailored approach. So an exit plan is most successful when you have 5 to 8 years, but if you don't have 5 to 8 years, it doesn't mean you shouldn't do anything. Hands down, you're better at doing something than doing nothing at all. So the beginning of an exit plan, you start with know your objectives. So there are 3 main objectives that you need to know. And those get into when you want, sell your business when you want, for the money you need, to the person you choose. So let's really dig into those because that's what every business owner needs to be able to answer those 3 questions. When you want is honestly, that's the reason why only 17% actually have business plans, is because you've been in business, you've devoted a lot of your life to it, and now thinking about life after business is terribly hard. So sometimes that's why people don't do anything at all. But I'm here to tell you, you need to put that stake in the ground at somewhere. You need to pick a date. Now, if you get to that date and you're still healthy, the business is still thriving, then you can move that date into the future. But trying to accelerate that date if something happens to you or something happens to the business can be really hard or could be impossible and could have financial impacts on you. The other thing that you need to consider is for the money you need. So the money you need is really you look at what you have, what assets do you have for your future or for your retirement, and what you need. And then there's a gap. Oftentimes there's a gap in there. So a lot of business owners think about what you need is the value of the business, but But theoretically, there's no correlation between those two numbers, so you really need to look at what you need and what the business is worth, oftentimes through a business valuation, and then determine if those two numbers are not in alignment, what can you do about that? And the last objective that you need to determine is to the person you choose. So oftentimes you might choose a family or insider, and that or another insider. So that would be transferring to an insider, which we're going to do a presentation on next week. But this presentation is going to focus on the strategic buyer and the competitor. So selling to a third party is really where we're going to focus our conversation at today. So BEI did a survey, and they asked business owners, who are you looking to sell to? So to put it into perspective, when you add up all the sales to insiders versus the sales to third parties, they're about equal. So there's no preferred. It really goes to what's best for your business. Do you have an insider that and can be able to structure it that way, or is the third party the best transfer option? So in order to successfully exit your business, you really have to have three areas that are ready. So the owner needs to be ready. So the owner, you as the business owner, you may have worked 30 plus years, 50 to 60 hours per week in the business, and thinking about being ready is really hard. The business needs to be ready. So no matter who you're going to sell to, the most critical thing in getting the business ready is that your management team can run the business. So oftentimes I have a business owner that will say, hey, I haven't taken a vacation in 20 years. Now I understand that you've worked really hard, really dedicated to the business, but that actually is hurting your business value, and it's really telling me that your business isn't ready for sale, because once you go away, then what else goes away within the business? And we don't want you to be the value of the business. So really, you need to have a management team that's performing the day-to-day management operations and can run the business. And then the marketplace. So as frustrating as it is, neither you nor I can control the marketplace, but we can control when the owner is ready and the business is ready. So we need to have the owner and the business ready, so when the marketplace is ready, that we can implement the transition. So let's dig into the third-party sales specifics. So why would somebody sell to a third party? Well, some of the main areas that I hear are the business is too valuable. A lot of times, if you have a large business with a high valuation, it's going to be hard to structure a transfer to an insider financially. There might not be an internal buyer, so the third party is the best choice. Oftentimes, the owner might want to receive a significant amount of cash at closing. If you sell to an insider, oftentimes they've been employees for you, so they necessarily don't have a lot of assets built up. But in a third party, you're more likely to get more cash right up front at that closing of the sale. And otherwise, the owner hasn't conducted any planning, so they need a quick turnaround, and the third party is typically the quickest turnaround. You need to determine the value. So we did do a presentation in January on valuation. So if you would like to listen into that, just let us know. But the value is really determined in three different areas. So there's the intrinsic value. So that's really your value drivers. That's the value of your business based on how your business is functioning. There's the extrinsic value. So that's really how does the M&A marketplace value your particular business. And then there's the promoted value. That's the ability of your advisory team to really encourage a buyer to pay more for your business. Then you need to look at tax implications. So will it be a stock sale or will it be an asset sale? So typically the seller wants it to be a stock sale and the buyer wants it to be an asset sale. So will the buyer even accept a stock sale? And then if it's an asset sale, what will the purchase price allocation be? So the whole goal here is to get the best tax implication, which primarily comes from capital gains in this transaction. And then what are the three biggest mistakes? The three biggest mistakes that I see most often in people selling their companies are failure to prepare. So oftentimes business owners will think that they're just ready to go to market, but that's not the case. Underestimating buyers. Oftentimes business owners will also think that, hey, the buyer is not going to notice this, or they're not going to care about this, or they aren't going to do as much due diligence as maybe some other buyers. And that's, if they have a good advisory team, that's not the case as well. So you need to be ready for that the buyer is going to do full due diligence. And accepting the first and sometimes only offer. So when that first offer comes in, a lot of times, you know, the seller will be excited, will want to just move forward, but without taking a good look at, is that the best offer that you're going to receive, and is that the best buyer for your business? So let's jump into some of the benefits of selling to a third party. I alluded to it a little earlier, that the speed. So if you haven't done a lot of planning, a third-party sale can be relatively quick. So once you have a buyer, you can usually close a third-party sale in a half year, a year at the most, as long as you're ready. Cash at closing. So oftentimes you want to limit your risk. What kind of risk are you willing to take on in a third-party sale? You can limit your risk by getting the most amount of cash at closing. Maximizing price. So maximizing price to a lot of people is really important, and we talked about that competitor, we talked about that strategic third-party buyer. Those are where you're going to get your maximum price, but you have to look at your business and say, can that competitor, can that strategic third-party buyer, can they develop my business relatively easy, or do I have something that they really need that will take them a long time to develop? And that's where you get into maximizing your price. Increased time margin. So we talked about you need to get your management team able to run the business, but essentially you're still taking a salary, but you have less day-to-day operations. So that's considered the time margin. You can control your departure date much easier in a third-party sale. So sometimes your departure date is on the date of the sale, or oftentimes the new owner will want you to stay on, want you to stay part of the team for a specified period of time, but that's something you can negotiate. So it's something you need to think about in advance so you're ready to negotiate and you get the departure date that you really want. And relative ease. So if you've done all your planning, selling to a third party can be relatively easy if you've thought it through and you know where you're going. Some of the other benefits include tax consequences. So in the negotiations with the third party, especially if they really want your business, you can negotiate some really good tax, essentially to get most of your sale at capital gains rate, if not all of it. But that's definitely part that you need your team to negotiate for you. The biggest downfall of selling to an insider, especially when that insider is family, is there's family conflict that you need to consider. So if you sell to a third party, you don't necessarily have to deal with that, and then you can treat the kids fairly and equally in your estate plan. Not to say that family conflict is a reason not to sell to an insider, but it definitely is a benefit of selling to a third party, is that you don't have to worry about those conflicts. Benefits to key employees. So oftentimes during the sale, you recognize that your employees have helped you build the value of your business, and you might give them an incentive upon sale. Otherwise, if you're selling to a bigger company, your employees might have better salaries, they might have better benefits. They might actually see this sale as a benefit to them in their future. And the successor choice. So if you do your planning right, you really do have the ability to choose your successor. So you can really tailor it and narrow it down to the best few successors for your business, given that they have the same culture and expectations as you do. Along with any sale comes challenges. So oftentimes, one of the biggest challenges is the business or the owner's not prepared. So that's not necessarily just specific to third party, but it is a big challenge in any exit that you need to really focus on. There's a high likelihood of earnouts in a third party sale or owner notes. So the earnouts leave you as the business owner with a significant amount of risk because whatever portion that you negotiate of the earnout is going to be subject to future operations, which you don't have any control over. So through the negotiations, we usually typically try to limit those earnouts, which limits the risk to a acceptable risk to you. In owner notes, seller financing, depending on who the buyer is and if they can get bank financing, is always a possibility as well. And again, you want to limit your risk of not getting paid because after the business is sold, you don't really have control. You're not able to step back in and limit that risk. Your value-based goals may not be met with a successor. So, if you're in a community that you're really passionate about and you want to stay in that community, a successor might buy you out, but they might not think that you should stay in that community. So you need to, all those value-based goals, you need to make sure that those continue to be met with a successor. And another challenge is the successor themselves. So a successor has their own culture. They have their own business operations. So they're really going to expect that your business is going to kind of mold into their business that they already had if they're merging you in. So you really need to make sure that the successor is the best one for your business. And with planning, you can do that. So let's get into what are some of the pitfalls of a third-party sale and things that you should think about. So one of the biggest ones, honestly, that I see is indecision. So I have a business owner that they think they want to sell, and they're not sure how much they want to sell for, they can sell for. So they decide to just kind of stick their toe in the market and test the waters. So they enter the market essentially to determine how much their business is worth. So it seems logical, but it can really be hurtful to the business. So the business owners typically go into the market really unprepared. They just jump right in. They haven't done pre-planning due diligence. They haven't gathered the information that anybody needs to determine what amount they will pay for the business. Inevitably, they end up getting low offers. So after they get a decent amount of low offers, then they pull from the market, and essentially the market is really tainted. So the market's perception is either that the seller is flighty and can't commit, and that could be. That's why the owner needs to take the time to get ready before going to market. Or something's wrong with the business, and there was some reason that they pulled from the market. So you don't want to create these roadblocks. So you really essentially can only go to market once. So you need to make sure that you and the business are ready to go to market when you do. Poor preparation is always one. So not thinking that you need to do all the pre-planning, and then when you do go to market, it essentially means it could kill the deal, or it could mean that you're just going to get a lesser value for your business. Another one is hiding problems from advisors or hiding problems from potential buyers. So oftentimes maybe you're going to lose a large customer, or there's risks that you could lose a large customer. Not disclosing that information, that's going to come out in due diligence. So not disclosing that information is really going to hurt you and likely is going to be a deal breaker for the transaction. If they find something in due diligence that you didn't disclose to them, then it really makes them question you and question business, and inevitably the business value is going to go down from there. And I see a lot of business owners becoming distracted once they go to market. So you have to remember, you still have a business that you're running, and you need to keep that business value at least at or above, what it was before you went to market. So a lot of times business owners only focus on the sale and forget to focus on the business, and the business value starts dropping. So becoming distracted can be a big pitfall that you need to avoid during the sale. So we talked a little bit about the due diligence, pre-sale planning. So what does that really mean? What are some areas that you need to think about? So financial statement analysis and any due diligence, a lot of weight is going to be looked at the financial statements. Are they accurate? Is everything reported in the right period? Because essentially that's likely a big factor in what they're going to pay for the business. So they need to make sure those financial statements are accurate and that the financial performance of the business will continue into the future. So if you're going to lose a large contract, that would have a big implication on your financial statement analysis. Analysis of corporate agreements and records. So is everything up to date, documented? This is a big one that they'll always ask to look at to make sure that there's no red flags there. One major one to look at is analysis of business agreements, contracts, and contingencies. So can those agreements, can those contracts be assigned to a new buyer? A lot of times, a large chunk of your business value is your business agreements, your contracts. So, you know, if those can't be assigned, how does that impact the business and how does that impact what the buyer would be buying? Capitalization versus amortizing items. So that's really looking at the financial statement analysis and making sure that you have all items accurately reported. Same with gain or loss recognition. Accounts receivable and customer relationships is a big one. So your customers also are likely your value in your business. So are those going to continue in the future? Is your accounts receivable all collectible and current? So eliminating bad debts is key, and eliminating bad accounts is key. So bad accounts usually equate to revenue for you, but they probably don't equate to the bottom line. So your business is actually worth more if you've eliminated your bad accounts and only have good accounts that will be transferring. Employee compensation and planning. So a lot of times once you start the third-party negotiations, you can't adjust any employee compensation. A lot of times the buyer has told you that you can't adjust any salaries, wages without their approval. So you need to make sure that those are all documented and fair before you go into the process. And then planning, you want to get the best tax strategy. So we don't lead an exit planning engagement trying, just with tax in mind. So we go through and develop what the best approach for the business is, and then find the best tax strategy, the best tax outcome for you. And why that's so important is because that really equates to how much you're going to really get out of this transaction after tax. So I just want to summarize what an exit plan really is. So an exit plan is now looking at those owner objectives, and we now know that there are three main objectives: to who you want, when you want, for the money you want. So you really need to look at all three of those areas, and then you need to look at, well, what do you already have, your business and personal financial resources, and then that all kind of all flows down into you want to maximize and protect your business value. You either want to sell to an insider or a third party, and typically you want to decide that before you get into developing your plan, because the steps are drastically different. Business continuity you need to take into consideration throughout this process. If something happens to you, what happens to the business? And then personal wealth and estate planning. So after you sell the business, what are you going to do? How are you going to continue to earn money on your money and retire? And that all boils down into a comprehensive exit plan, which really helps. It's really the roadmap on how you're going to exit your business, just like your business plan was the roadmap on how you're going to get into business and how you're going to operate during that time frame. So this is just an example of an exit planning assessment that you can take. So we will send out an email that will have a link to the assessment that you can take, and then we'll meet with you to go over This really identifies the areas, all the different areas that you need to think about during an exit. But this is tailored towards your business and really gives you areas to focus your attention on to which results in a successful exit. Then we also have 3 ebooks that are available for download at the various sites below that I suggest that you take a look at. Now at this time, we'll take questions.
Thank you, Nicole. Again, you can ask your questions via the chat feature. One little thing I wanted to mention, I know that we went through that ebook slide rather quickly, so you will be receiving a survey afterwards this afternoon that will have the link to the assessment in the survey, but then we'll also have links to those 3 ebooks in that survey email as well. So we did have a couple questions come through during the presentation. One of it is, if I am one of the 83% that don't have a plan, where do I start?
That's a really good question, and that's honestly a lot of people's question. Whenever I meet with a business owner, that's one of the first questions that they ask. So you really need to go, you need to look at those 3 main objectives that everybody needs to answer. So when do you want to sell? So you really need to determine where am I going to put that, where are you going to put that stake in the ground, which is the hardest one to do. For the money you need, so typically that starts with a financial plan to determine, well, what do you have and what do you need in retirement? There's a lot of numbers floating out there, but you really need to look at your spending and what's your lifestyle on specifically what you need. And then to the person you choose. So as I said, throughout the exit planning process, you only really want to go down one route. You either want to go to sell to an insider or sell to a third party. So you don't just want to jump into the plan right away until you've determined that. So oftentimes I work with clients who say, well, I do have a few insiders that are a little interested, but I don't know if that's the best route, or I don't know how interested they are. So typically that's where we begin our engagement. We begin by figuring out, are those insiders the right choice before we go down the route of developing the plan. So I'd say really just looking at those 3 areas.
Great. Our next question came through, what if I'm unsure if I should consider an insider or a third party?
Yeah, so that kind of goes along with the last question of you really should take time. You should talk to those insiders. If you do have insiders, that's probably the first area that you're going to start. And you should talk to those insiders and see, are they really interested? What we find sometimes is you think they might be interested and they're really not, or sometimes they really are interested and then but they need to determine, what does it mean to own the business? What does it mean to operate the business? What's the financial implications of it, and how is that all going to work? So typically I would start with talking with that insider, determining that if that's the best option or route and you as a business owner feel like it is. If not, then you should move on to the potential of selling to a third party.
Great. We are almost out of time, so I just wanted to take the last minute that we have and mention that we do have some upcoming webinars in our exit planning webinar series. If you are unsure, like the last question asked, if you're unsure whether you want to sell to an insider or a third party, our webinar next week, February 21st, is preparing your business for a sale to an insider. Also coming up on March 7th is closing the gap in building value in your business. For more information and to register for those 2, you can visit svaaccountants.com/events. Again, I want to thank Nicole. Also up on the screen was Nancy. Nancy will be presenting next week's webinar on selling to an insider. Both of their contact information is on the screen, so if we did not answer your question today, or if you think of any in the coming future, feel free to reach out to both of them. So thank you so much for joining in, and I hope everyone has a wonderful day. Thank you.